What people say can't happen often happens. And especially when their belief that something can't happen causes them to have participate in the system in a way that actually causes more problems. So like financial markets, people say it can't crash, so they start acting in very risky ways that actually causes the crash to happen. People believe that something is indestructible, so they treat it very poorly, which causes it to eventually break. You see that type of circular systemic type action out there quite a bit. And what's happening right now with the financial markets is exactly that. People believe that the financial markets can't break, and so they're engaging in riskier and riskier behavior, which I believe makes the market crash and the catastrophic financial collapse all but inevitable. It's just really a question of when. And I, for one, have been surprised that it has lasted this long. I'm going to walk you through some of the mechanisms, some of the risky behaviors that the market and market participants, particularly banks and investment bankers, are doing today that really do echo what happened in 2008, because this is setting up for a lot of people to be burned and a lot of people to lose a lot of money. Let's jump into it. Welcome to the Poplar Report. I'm Steve Poplar. I'm an accountant by trade, and I know a few things about banking and some things about the proper way of running a business and the proper way of managing your money. So we're going to be talking a little bit about that. So market crashes are fueled by risky behavior, right? Now, if you're familiar with these things, I'm going to touch on them real briefly, but I'm going to present them in such a way that if you're not familiar with them, that you'll be able to follow along with what we're talking about. So basically, a risky thing to do is to take your stock, you buy company stock, and that's all good and everything like that, but then you use that stock as collateral for a loan to buy more stock. That's called being leveraged. That is what causes market calls. So basically, when you have that degradation in value, when the value of your stock goes down, you've borrowed this much money, but the value of your collateral has gone down. And this is when you get a call, a margin call. And when you get a margin call on you, they basically say, you need to give us more money. You got to give some of that money back because you can't borrow, say, $100,000 on $80,000 worth of stock. You can't do that with a house. You can't do that with stock. So they're going to make you sell $20,000 worth of stock. But since the price of the stock has dropped, you're selling at a loss. So you have to sell even more of that stock than what you would have if you had sold at the top. And this forces people to sell because the banks, they're not polite about it. They say, you sell the stock right now, or we're going to sell it for you. And when they sell for you, they don't really care how much money you make out of it. They just want their money back. And I promise you that when you start seeing these margin calls across the stock market, it really starts moving things fast. And that's why we saw in 2008, we saw a market crash because as value of stocks came down, more and more people were forced to sell. Other people started to panic, and they think that it's just going to keep on going down, and so they started selling, right? And so we have, until everyone quits, it won't actually bottom out. Back in 2008, the S&P 500 basically dropped 57% from market top to market bottom, 57%. I want you to imagine if you have a retirement account, losing 57% of that. If you have a brokerage account or whatever, 57% of your money gone. Now, I know you look back over history and say, well, then you should just hold on and then just wait for it to go back up. Well, the Japanese had a market bubble, right? And in, what was it, the 80s? And when it came down, it took, I believe, 35 years for it to break even to where it had been. If you had bought stock and you're like, and it crashed and you're like, I'm just going to wait until it goes back up again. 35 years to break even. And I promise you, a yen 35 years prior was not worth the same thing that it was 35 years later. And if you want to wait 35 years for your dollar to be worth the same, for your stock market to be back up to where it was, how much is that dollar going to be worth? With the rate we're going, you might be able to spend $100,000 to buy a hot dog at Sam's Club. So that's my word on that. Now, some people say, well, stocks will go down, but bonds will be safe. Bonds are basically just loans, right? If you loan money to a corporation, that's a corporate bond. If you loan money to this, city of Chicago, you'd be an idiot, but that would be called a municipal bond, right? And these bonds, they go up and down in value because you give them a 30-year loan, and you may not want to hold it for 30 years, so you're like, hey, I'll sell this to somebody else who wants it. Well, bonds, and particularly high-risk bonds, people call them high-yield bonds, but of course, I think it's more importantly to call them what they are, which is high risk. People realize that they're risky, so that's why you get a little higher yield, right? They're like your they're like one of those payroll companies that's like giving payroll loans out, right? That's super high risk. Or credit cards, they're super high risk. You might default on them, right? So they have to charge you a higher interest rate because people don't all pay them back, right? So if you're loaning money to creditors like Chicago that are just probably not going to pay you back, you should get a higher interest. But as they become more risky, the interest rate goes up, but the value of the bond goes down. You can't sell it to anybody. You have to discount it before anyone will want it. Nobody wants it. So bonds, which are considered out there safe, high-yield bonds or junk bonds, dropped by 45%. And a lot of very safe investments in 2008 went to zero. People often aren't prepared for that. And we see this risky behavior across the board where people are borrowing against their stock, borrowing against their bonds, so they buy some bonds to Chicago or whoever, and then what they do is they then borrow money against that to buy more bonds so they can get all that interest. And they think that they're so smart about it, but really what they're doing is engaging in extremely risky behavior. Some people will get into stock market options, which allows you to basically gamble on the direction of anything from bonds to stocks. This allows you to have even higher leverage. So if it goes up a little bit, you may make a lot of money. But if it goes down a little bit, you may lose a lot of money. And not only that, but they're set up in such a way that the house always wins. If you think going into Caesars Casino in Vegas or one of the other ones, MGM Grand or whatever, if you think that's a good, wise investment because, you'll probably be able to figure it out. The house always wins, friend. And that goes not just for casinos, but it goes for the stock market as well. The main banks, the big banks out there that are selling options, they always win. And it really is gambling. So, all of that to say, people are engaging in buying more options. They're engaging in more risky behavior. They're taking higher leverage. They're taking out more loans against the stock market because it can't go down. Because they believe that if the stock market goes down, the Federal Reserve will cut interest rates and the stock market will go right back up. Because that's always worked before. And like I said, when people believe something's impossible, it makes it inevitable. People think it's impossible for the stock market to go down, which means we're probably going to see something very, very different. The stock market, the S&P 500, which is kind of one of the main index of companies out there, it covers a broad spectrum of companies. Right now, they're at 20 times earnings. So if you want to buy a chunk of McDonald's or you want to buy a chunk of other companies, on average, you're going to pay $100, and every year roughly speaking, they're going to be making about $5 a profit. So you buy a $100 share of stock, they're going to be making $5 a profit. So basically, to break even, essentially, you need the company to be stable, and you also need to wait 20 years for that to make profit. Now, that by the end of that, if that all happens, if profits are stable and everything like that, you'll now have your initial investment, plus you'll have the equivalent amount of your initial investment in cash if they spin it off in distributions. 20 years. Do you really think things are going to stay stable for 20 years? Do you think that nothing is going to go wrong in 20 years? Do you think that all these companies are going to be making just as much money as they were 20 years ago? 20 years ago, I think people still thought that Blockbuster was a good investment. 20 years ago. Go back 20 years and look at the companies that were on fire. How many of them are still on fire today? And the ones that still are tend to be the companies that have higher rates. So you're not looking at 20x on those. You're looking at like 40x on those because they're so stable. Friends, that doesn't make sense. That's crazy talk. If you want to go to the bank and you're like, I have this cool business idea, it's going to make this much money, are they going to take that and go, well, we'll give you 20x on that? Oh, you think it's going to make $50,000 a year? Let's make it easier for me. You think it's going to make $100,000 a year? Let's give you, that would be $2 million, right? Let's give you a $2 million loan for this investment for this business. That would be crazy because they're assuming that everything's going to work out great for 20 years. They would never do that. They would want a lot more collateral, and they'd be wanting to cover their butts pretty well. But investors are not like that. Investors are like, just take our money. Just take our money. It could never go wrong. Well, friends, in stock market crashes, in downturns, let's just say that number drops dramatically. And you can easily see the stock market dropping by half to 75% even to get back to what fair market values in a difficult economy, a difficult time would be like. A lot of businesses are going to go to zero. And people aren't prepared for that. People think that companies can't go to zero. And yet they do, and they have been, especially in the last couple of years. We've seen a lot of companies actually go to zero. And that is not a good sign. Things are getting difficult for the financial markets out there. Let me give you one more example of something crazy that's happening out there. And this is one of the reasons why I talk so much about precious metals like gold, silver, platinum. I mostly am a silver guy. I'm a silver buff because of this. You look at how much physical silver there is, and then you look at how many people own silver, paper silver as we call it. There's 250 ounces of traded silver for every 1 ounce of actual silver. And if you're like, that doesn't make sense, that you can't do that. There's 250 ounces of shares of silver, people promising you silver, versus 1 ounce of actual silver in existence. So if even one of those 250 people actually were to buy silver, buy the physical metal, there wouldn't be any more metal. The other 249 people would be just sitting there with a promise of silver that will never be fulfilled. And that's kind of the craziness that we're seeing out there. You say, that should be illegal because that doesn't make sense. That's a Ponzi scheme. You're right, it is. But somehow it is legal. Why? Because the securities people out there don't believe it's illegal. You can take the one ounce of silver and you can sell it 1,000 times. And technically, you're not breaking the law as long as you do it in the right way. And that's what banks are doing out there. So a lot of people think that they're invested in silver. A lot of people think they have silver, but they don't. And at some point, somebody's going to call their bluff on that and say, deliver the silver. And when they do, and there isn't any silver, the whole scam of it all will be shown. And similar things are happening to gold too. We're having people promising that they'll deliver gold if you really want them to, and so that's what they're selling you. But then when it really comes down to it, they are not showing any independent audit of actual gold that they have. How much gold is sitting in Fort Knox in Kentucky? Nobody knows because we just have the government's word on it. They haven't actually let anyone see the gold for many, many years. But trust them, they would never lie to us. A lot of people speculate all that gold has been sold to China. And the gold is just, we're just pretending we have gold. If that's true, we could be in for a world of hurt. As BRICS countries are switching to gold and silver and precious metals backed securities and currency, we may see something change out there pretty dramatically, and that would break our financial markets. If you see banks completely imploding because of how they've been manipulating and how they've been lying about their use of precious metals, you'll say, Steve Poplar, he was right about that. That's why I highly advocate when this thing blows up, you will be looking pretty sweet if you have precious metals in your pocket. If you're not bound to a retirement plan, I recommend just buying the metals directly. I like buying mine from Walmart. Get my 5% cash back Walmart gift credit card, and I get to order them online, get my 5% cash back, and it's the cheapest way to go. And you don't have to buy tons and tons. You can buy smaller bits. And then you can take physical possession of those, and you can go bury them somewhere in a neighbor's yard or, you know, somewhere where they can't be found. You know, I mean, a boating accident, right? That's what's coming our way, friends. I think precious metals are going to be the best safe harbor there is. That's where I'm hiding. Real estate may be a fairly good hiding place, but when we talk about houses, and a lot of the houses are inflated in price, and they may come down in price, but having real estate allows you to have options if you own the ground beneath your feet. But with real estate taxes, do you really own anything? That's a whole question for a whole nother day. But hopefully that gives you an idea of what's going on with the markets out there. It gives you just a brief summary of kind of why we have a lot of concerns with what the bankers are doing. Pop your thoughts down in the comments down below. And thanks so much for joining us. If you want to check out another video from this channel, there's one right up here. I'll see you over there, or I'll see you guys later. Steve Poplar of the Poplar Report, out.